Be Wealthy and Smart, episode 1187.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about how there's so much going on, but really all eyes are on the Fed, because the Fed meets on Wednesday, and that's when we're going to hear their decision about interest rates. More about that in a minute. But besides that, we have so much else going on this week. We have a heavy week of corporate earnings to be announced with AMD and Starbucks, Ford, Pfizer, and Uber set to report tomorrow ahead of Wednesday's Fed announcement. Now today, of course, we had First Republic Bank taken over by JP Morgan Chase, and that was by special exemption because now Chase has more than 10% of all banking assets in the U.S., which is normally not supposed to be allowed to happen because that makes them a too big to fail bank. But in these times where nothing's normal, of course it got approved, and JP Morgan ended up with the assets of First Republic. Also today, Treasury Secretary Janet Yellen warned that the U.S. may run out of its ability to pay its debt obligations by June 1st, which is earlier than they originally had thought. She said new data on tax receipts forced the department to move up its estimate of when the Treasury Department will be unable to continue to satisfy all of the government's obligations to potentially as early as June 1st if Congress doesn't raise or suspend the debt limit before that time. Now, originally, we were looking at something around late July for that to happen. So Treasury Secretary Yellen moving it up to June 1st is a pretty big deal. Goldman Sachs also said that weaker than expected tax receipts could move the timeline up even further, so even closer than June 1st. CBO Director Phil Schwegel said because tax receipts through April have been less than the Congressional Budget Office anticipated in February, we now estimate that there is a significantly greater risk that the Treasury will run out of funds in early June. And there's only 8 legislative days this month during which both the House and the Senate are in session at the same time to get this legislation passed and to get the debt ceiling raised. That could significantly impact any effort to hammer out a last-minute deal. And in the category of you can't make this stuff up, this article on CNBC's website says the Goldman Sachs estimate noted that so far there have been few ripples, yes, it used the word ripples, in the market from rising debt-related risk. But this could change, analysts wrote, once the Treasury announces a specific deadline for Congress to raise the debt limit. So while there's a lot more attention being paid to this issue with the debt ceiling, and the risk there is not only a temporary default, and I say temporary because usually even if they miss a deadline, they do increase the debt ceiling limit at some point. At least that's what they did back in 2008, which is kind of this cycle happening all over again, including almost exactly 15 years to the day when Bear Stearns went under, we have First Republic going under. Cycles do repeat. Now, we know that the Fed is meeting on Wednesday, and they have a very important decision to make. But before we talk about that, let's look at some of the data that they're going to be reviewing before they decide on whether to raise interest rates or not. They have statistics from the Institute for Supply Management's Manufacturing, PMI, which came in at 47.1 in April, which is above the previous month's reading of 46.3. And better than was estimated. 47.1 is what came in, 46.8 is what was estimated for the number. But realize that any number below 50 indicates that the manufacturing sector is generally contracting. So we're not growing, we're contracting, which would be a reason for the Fed not to raise interest rates. It's considered a forward-looking indicator of economic activity, and it's been on a downward trend since March of 2021. So right now, The futures markets are placing an 87% chance that the Fed will raise interest rates by 0.25% on Wednesday. That 0.25% hike in interest rates would make the Fed's benchmark rate in the range of 5 to 5.25%. And the benchmark rate hasn't breached 5% since July of 2007. So all eyes are going to be on the Fed about what they do with interest rates and what they say specifically about the future of interest rates. JP Morgan economists wrote, "Our expectation is that the committee will effectively signal a pause, but with a bias to tighten." And they pointed out Powell's exact phrasing during Wednesday's press conference will be crucial and is closely watched for Fed speak, similar to the central bank's rhetoric amid rate pauses in 2006. And then after Wednesday, they're going to get important data in on the April non-farm payroll jobs report, which is expected to show 180,000 non-farm payroll jobs were added to the U.S. economy last month, with the unemployment rate ticking slightly higher to 3.6%. Now, the Fed has been wanting unemployment to get higher, so that's moving in their direction of weakness, and we have a contracting economy according to the PMI. So both these indicators look like they're going to be showing more weakness. And with a bank failure, that was the black swan event that I mentioned could happen that might make the Fed change their tune. You really don't want to be tightening in the midst of problems in the banking sector. You want to be adding liquidity, loosening rates, and instilling confidence. This is not a good idea for the Fed to be tightening yet again, and they should take a break. But if they don't, it's possible that we see more banks in trouble, with more banks coming under pressure, especially small to mid-sized banks, as assets flow to the larger banks where people feel a little more secure. Now, technically, if you're under FDIC insurance, you should be fine in a smaller to mid-sized bank. But it's so easy for people to move money these days with apps and electronic means to just click and move your money. The futures market, again, has priced in an 87% chance that people think the Fed will raise rates by 0.25% on Wednesday, although then likely pause after that. We'll see how it goes, and we'll be tuning in to listen to what the Fed says is their next step after their decision on Wednesday. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.